There's no shortage of explainers on what an ownership coin is. What I haven't seen anyone actually do is sit down the people deploying capital and ask the blunt versions, what makes them easier to underwrite, but also where does this design fall short today?
Right. because the structure can look quite elegant on paper, but the real test is whether it survives the due diligence process of seasoned investors when it's their money and their reputation on the line.
Yeah, so that's the whole show. No pitch, no shilling. We've got 2 investors actually deploying into this. We have an advisor who sits between the investors and the builders, and the co-founder who built the thing. They're all going to poke holes in today. Let's find out where they disagree and what it takes to get them excited about new projects in the space.
Yep, so let's meet them. First of all, we've got Felipe from Theia, a fundamentals-driven crypto fund that thinks seriously about token rights, cash flows, and what investors can actually underwrite. Welcome, Felipe.
Hey, good to meet. Good to talk.
Next up, we have MJ from DBA, a crypto investment firm active across private and public markets. And that's somebody who's been paying close attention to MetaDAO, ICOs, and internet capital markets in general.
What's up, guys?
Hey, MJ. Hey.
How are we doing? Good to see some familiar faces and new ones. What's up?
And then we also have Connor King from Novora, who works with crypto protocols and capital markets and investor relations. Hey, man, how you doing?
Good. Appreciate you guys having us on. Super excited to be here.
And we also have Cole in house, hopefully soon. He hasn't been able to join the stream yet, but he'll be with us hopefully in a couple minutes. It's good to have you here, all of you here, gentlemen. It's an honor and a pleasure to sit down with you and talk everything about MetaDAO and ownership coins.
Likewise.
So since Colin isn't here and I was supposed to be asking about what an ownership coin is, I guess I'll just let one of you answer this question. Let's say Felipe. I'm going to select you for this first question. So for anybody who's just tuning in and doesn't really know what an ownership coin is, just in 60 seconds, could you tell us what an ownership coin is?
Yeah, in 60 seconds, an ownership coin is a structure designed to align token holders and a company's management team on the same incentives. And those incentives are explicitly to build a large and profitable business and return the profits of that business to token holders in the way that in the same way that we've seen companies do that across multiple countries and in the US, governed by doctrines like shareholder primacy in the US. We have to redesign the way, a way for token holders and company management teams to be aligned in internet capital markets, because they don't exactly, the same rules don't exactly translate. And ownership coins are by far the best attempt, and I believe a complete attempt to do that and align incentives appropriately.
Love that, man. No, I think sticking on that, in your underwriting process, Felipe, I think you discount tokens by how much value leaks away. So whether cash flows to the token, whether holders have real IP and rights, whether some labs entity is capturing the upside instead. Most tokens eat a big discount, I'm guessing, on that scorecard. Can you walk us through where an ownership coin actually lands? And does that structure genuinely close the gap to something like equity, or is there still leakage in that wrapper?
No, I believe it closes the gap. I think that ownership coins should not trade at a discount to equities for the same underlying business. So you said it, tokens should trade at a big discount to the underlying equity because there's significant value leakage, and there's also misaligned incentives. So teams don't always have the incentive to build a business. They may have the incentive to pump a token, sell their share, right, and then walk away from the project. And we see that happen all the time. And then there's obviously the situations where they can sell the company to an acquirer like Coinbase and get paid out as a team and pay out, maybe some VCs and walk away without paying any token holders. We see that all the time. It feels like every week there's a new case of that happening now. And then there's ways to kind of siphon cash out of the offshore companies without building any value, really. But there's all these problematic incentives. You don't have those ownership coins. In fact, we'll see where the market share shakes out, but I personally rather hold an ownership coin than a private equity share in the same underlying business, because it's liquid and because it's governed by decision markets, which I believe to be intrinsically more token holder or shareholder friendly, depending on which asset class we're talking about. Because a lot of attacks, small attacks that we do see in equity markets, where the board or the major holders can kind of direct the company, are not possible with decision markets. And I'll just give one really easy example to make that concrete. If a company is going to fail and they have cash, it's really not that easy in a venture structure to redeem the cash and get the founder to move on. You have to convince them. It's possible to get everyone aligned and the team aligned depending on the structure, but it's not easy. Whereas with an ownership coin structure, you can actually redeem that cash once the market knows the business is going to fail. And I'm sure that there are thousands of venture investors in the crypto space specifically who gave money to teams in 21 and 22, building the nth, MM on the nth chain, EVM chain, who wish they could get their money back and can't. So that's one example. I think there are many examples where ownership coins are actually stronger than equities for the investors.
It's such a good point. And maybe, Connor, do you think that's why crypto or trusting crypto has been so expensive? Like, why do we only see projects that dedicate most or all of their net revenues to token buybacks or revenue shares actually entice investors? Can't we be content to call these projects startups and allow them to compound on their growth? Or is that why you need some kind of buy-in at the token level?
Yeah, I think what's great about ownership coins and like the way that the structure is, right, is like a lot of most crypto companies are like early stage startups to begin with, and with the natural like alignment of what ownership coins enable through like the enshrinement of rights over like the IP and the actual business, is that like if you're let's say like a $10 million company that's maybe generating like 1 million, 1.5 million, maybe it doesn't make sense to do token buybacks at that early stage because you want to like continue to reinvest in growth, which is great for the business. And like ownership coins ultimately enable that, so you can just reinvest profits back into the business and grow the company, because there is already existing alignment with what they kind of claim that ownership coins enable right off the bat. Whereas like if you're more of a traditional token launch that maybe is valued at like 3, 4, 500 million that does buybacks, but maybe the token doesn't really the sync there doesn't overweighs just the overall value capture there. So I think like the natural alignment, like the constrained alignment of the token holders is much larger, and like we've seen that. And like Felipe alluded to earlier, there's just been countless times where there's misalignment in the equity versus the token business, whether that's like a deep in protocol, like what accrues value, the equity business for like the holdco or the actual token, or a traditional like M&A structure where you have a token that gets acquired by someone like Coinbase and the token holders are left to dust. I think ownership coins and MetaDAO ultimately and really alleviate a lot of those traditional headaches.
And awesome. And the next question here goes to MJ. So DBA, at DBA, you've seen plenty of clean equity deals, and you invest across private and public markets. When you look at ownership coins, what makes that more interesting to you than just doing equity? Is there anything that you think that the token can do that the equity cannot?
Yeah, I mean, to us, the ownership coin innovation reminds me of the safe. A lot of people don't know the financing history of private companies, but we used to do preferred equity. A preferred equity transaction takes between 6 weeks and 10 weeks, and it costs 30K to 100K, depending on what type of governance, covenants, et cetera, is in the docs. And so we moved to what is considered a convertible debt structure, which is you just give the company capital and they pay an interest rate back. At some point, people thought, this doesn't really make sense for the right way to finance an early company. We don't need all this stuff, and we need a much lower friction way to get a company capital quickly. And when we saw the structure, I thought it was a logical next step. That's like what comes after the safe for startup financing. You can do it much quicker. There's way fewer terms to negotiate and think about. We don't spend a couple of weeks on red lines with attorneys. And you also get all the governance rights that a safe misses. So a safe really has absolutely no control or governance. It's an outstanding instrument that has to convert before you have real rights and controls. And so what you've seen in venture, specifically in crypto venture, is this kind of bastardized, what's called NVCA. NVCA is the kind of standard charter rights that everyone puts into the traditional pref equity deals. That gets put in what's called a side letter. A side letter exists outside that instrument. And why I'm being so specific on this is this really is an actual innovation. This is just net new, this ability to get a company capital quickly. And why we're so excited about this is we don't think you need to do this traditional 10% private financing every single time you do milestones. We think there is a world where you do 1% transactions, where we have clear KPIs and metrics that are hit, and companies are able to raise capital lower price for them because they're selling less equity quicker, and it takes less of their headache to do so. And so that's why we think it's just a fundamentally different construction. What comes out of it, there's a lot of different questions, but that's why we think it's just so fundamentally different.
Makes a lot of sense. And are you guys, or is anybody seeing teams skip tokens entirely right now, just default back to equity because the token market conditions are so rough? Do you think MetaDAO, like the MetaDAO structure, can help change that calculus enough to bring those teams back, or is all lost?
Capital comes back quickly when there are good returns. If returns were really high for funds investing in MetaDAO tokens, capital would be back in 12 to 18 months. Like, there's never a situation where returns are really high for some segment of funds, and then capital decides to abstain for indefinitely. So if MetaDAO launches with good companies and they build big businesses, and the people on this call all get good returns, it won't be an issue. And look, we are seeing people really leave. Sorry, Michael.
Go ahead. You finish the thought.
We are seeing people really leave the token space, and we're a liquid fund. We still own a handful of tokens. That's all that's investable in the liquid space. I don't blame them. Like, I don't blame people leaving the liquid token space. The last few years have really been a testament to how good people are at following their incentives and how broken the incentives are in the liquid token space without MetaDAO. So maybe this, maybe it's my most histrionic opinion that I like to recite, but I think that the entire token space does live and die off MetaDAO. That's my personal opinion.
Did you have more thoughts, MJ?
Yeah, I think the difference generally between what we think of like traders and funds, or retail and institutions, are that if you're a retail trader or a trader in general, you have to kind of think about the world in the current regime you're in. Whatever rates are, whatever equity multiples are, that's how you think about things. You think of continuation and exhaustion of that trend, and you'll buy and sell and position assets accordingly. And that's very much what you see in retail-driven markets. Our job as a fund is to think through multiple regimes. What could happen as things change, what happens to the companies, and what we think about with MetaDAO and tokens specifically is there's a thing called a Stackelberg game, which is, it's the opposite of Nash game, where instead of everyone goes at once, a leader goes and then people react to the leader. And that's very much how markets are. There'll be a regime shift. It looks like we've gone through a regime shift a bit in large cap crypto recently compared to alts, and then people start to make net new decisions based on that new regime. And so our view is, as soon as there is a set or signal lighthouse that comes out of MetaDAO that shows the quality of the company and the quality of the asset performance is net better on a cohort basis than the non-MetaDAO companies, everyone will start to go to that structure because they'll react. It's a reactionary market. It's not a first principle derived single regime market.
So do you think it's just more shots on goal then?
It's funny. I was having breakfast yesterday with a friend who was an investor in Anthropic early. Not a great fund, not a fund you guys have ever heard of. And he said this investment bailed out the entire platform. And that's just kind of venture investing in general. You get one or two hits and then you become a survivor, and the survivors tend to win and they get the next one or two hits. And it's not to say that you should have a complete naive no set of logic about how you make selections, but I think you need a real humility that you can't predict exactly what's going to work and why. And I think that's the right thing for MetaDAO to do. I think we should be in a hyper experimentation phase. I think we should try everything, permissionless, permissioned. And when one thing works, everyone will chase it. I'm a crypto boomer. I've been doing this too long. And I remember when we went from Ether Delta, which was the original kind of peer-to-peer Ether swap DEX, to Uniswap. And that AMM market actually had lots of criticisms and ideas. And as soon as the AMM worked, everything's an AMM. I think that's very much what we'll see here, which is we're kind of in the pre-AMM ownership coin phase. Once we have a Uniswap hit, I think everyone will switch to this model.
And what kind of people turn up to these raises? I think one trend that I've sort of noticed is all the hyper speculative capital, all the people who like to trade on pump, and these gambling sites. They don't really show up to these MetaDAO raises, at least from my understanding. So I guess this is a question to Connor. What kind of investors are showing up to these raises, do you think?
Yeah, I'm happy to share some thoughts there. And then obviously, like if you're comparing to like something like Pump Fund or Meteor, et cetera, I think what MetaDAO does a great job is like they're putting out like real businesses and startups with real founders that are building real products, generating real revenue. So you by nature just have a different holder base, which I think is great because like you want like long-term sticky capital. You have people like DBA, like Theia in your corner, which is great. And I think that's just like a healthy maturation phase of this industry, and maybe like why it hasn't attracted like speculative capital. Since Novora got involved in the MetaDAO ecosystem in Q1, what we have seen is there's way more institutional interest coming in now than I think last year. And that's been like a core focus for us, is to like really kind of further build out the investor universe and cohort within MetaDAO, the MetaDAO ecosystem. But with that has been just a long kind of educational phase and period, because a lot of these guys just weren't, quite frankly, familiar with the MetaDAO model or what the platform enables. So you just by nature have this kind of educational period to get institutions comfortable understanding the technology, and then that enables them to further underwrite upcoming ICOs, which is where we're spending most of our time on a day-to-day and week-to-week basis. But I'm excited. We've seen a lot of net new institutions express interest and get involved in future launches, and I'm excited on that path. And we're going to hope continue to kind of get that trajectory higher and growing at a much quicker rate.
Something that we talk about with Theia a lot is identity in both the investor and trader market here. And by that, I mean like actual governance decision market trading. If this goes well, we actually, at least this is a DBA perspective, it's a Michael DBA perspective, John and I debate this, is how much should the participants in the ICO be known? And then how much should the traders in the markets be known? Because we think that if this is done really well, very separate problems and situations, founders should know that they have the ability to raise from people who are good or who are going to govern differently. We are willing to give a company 2 or 3 pivots, for example. We're not going to ask for our money back if the first experimentation doesn't work. We're very comfortable with that. That's the risk we often take underwriting these companies. If there's fraud, if they're not acting, of course, we're going to ask for our money back. But we think there needs to be a set of identifiable actors in the ecosystem who say, here's what we believe, here's how we govern, here's what we think. Come work with us if that's the right thing to do. And the downside of that, the kind of public criticism you'll get is you'll get insider games that only a certain set of people will participate. And we don't think that's the right construction either. So I think a lot of the really interesting innovations you'll see this year and next in both the ICO, the capital formation, the capital governance perspective will be identity of disclosing it, proving it, signaling, et cetera. And the last thing I'll say on that is the actual trading of the markets, I actually think needs identity. I think we should be very public about why we're doing what we're doing. We often will comment about what we're going to trade, and that gives the founder a level of certitude. Like, we're not going to say just because you're below NAV, we're going to ask for the money back after 3 months. We don't think that is a good long-term multi-regime equity value, enterprise value creation structure. We should say, if you do something wrong, if you misrepresent, the money's coming back, but you have the rope to work a little bit and try and experiment, because these are $10 to $30 million valuations. That would be insane to run this thing like a public equity, give people some chance. So, I think identity is a really interesting dimension here.
Can't hear you, Felipe. Yeah, I think that honestly, it leads me into my next point. Like, I think a lot of folks go back to the Ranger example, right? So if you have this project that launches on MetaDAO, does that threat of liquidation constantly weigh on their mind as founders? Do they always have to have like their foot on the pedal to avoid that liquidation?
In a pure anarchic model, which is the market decides, yeah, people are going to say, if it's positive EV for me to liquidate you, I will liquidate you. And that's why you need kind of like long time. You need to be able to pull people's reputation and other things into this to say, we want to be able to, we'll trade this market. Even if you're in good faith and still working towards something, we think the right thing to do is to trade yes. So yeah, we that's a big issue if we're talking about kind of risks. If the market continues to be governed by traders, like pure EV traders, that's kind of scary for MetaDAO, because you're going to get hyper short-termism and you just can't build. Every single good company has had a mode where they would have voted to return the money. That's just true. Over a period of time, you're going to go through a negative EV period, and we just can't allow that to be the default return model.
Can you hear me now?
Yes, sir.
Great. Yeah, want to completely agree with Michael on both counts. So I think it's a matter of identity, but it's also a matter of ecosystem and who you have trading. So we at Theia, for example, will also give companies multiple pivots if they're working hard and thinking intelligently, but would want to return capital if a team is not going to work out, or if a setup is not going to work out. So and, it's just part of. Right now, it's a big part of the founder journey. It's learning who you can rely on as an ally. For example, we like to help teams structure proposals and then trade aggressively to get them to pass, because by definition, we structure proposals that we believe are EV positive, right? And because we believe they are EV positive, we're happy to buy the pass market aggressively with our fund. And that's the kind of thing that you need to be aware of as a founder. Who are your existing allies in the field today? That's a lot of what Connor's doing at Novora is getting founders long-term capital that can help them navigate these markets. And it's not something you can really afford to be ignorant of. So I'll give you one example. Solomon put up a proposal earlier this year. Anyone who's really involved is aware of it, to take some treasury out and run it through their own product. And we saw that it was failing in the middle of the vote because some short-term traders decided it could be more profitable for them if the proposal failed and they were able to liquidate Solomon. At least we think that's what these traders were doing. It was an obviously EV positive proposal. Within about a day, Theia, DBA, and a few others, I believe DBA was doing this, started trading the proposal because the founders alerted us to the situation, and it passed just fine, right? But I highlight that situation because had there not been that communication outside of like offline, it might have just failed, right? Because of who was trading that particular market at that particular time. And it was short-term traders who had a more mercenary view. So I think the lesson is, if you're a founder, you should be aware of who your long-term allies are in these markets. And right now there's a few of us, and hopefully there'll be many more over the course of the next year, and use them. But I think the broader lesson for MetaDAO's ecosystem is that the markets will reflect the investors and traders that you have inside of them. So, to Michael's point, I really am agreeing with you. I think the mechanism can actually work if you have the right investor set. So people talk about the Facebook acquisition case, where Facebook was offered a buyout at, I think, $1 billion, or I forget the number, but it was a number much smaller than their current market cap. And Theia decided to block the acquisition, right? And some VCs wanted out. And people point to that as kind of a failure mode for MetaDAO. It's like, if you are offered an acquisition at above market price, wouldn't it just go through? And the answer is actually not necessarily, because an acquisition going through means that there wasn't a large investor or a set of large investors that believed you were worth more than that. And in the case of Facebook, Theo could have single-handedly blocked the acquisition by buying up the entire supply, or the entire supply that was willing to sell the company, and just gotten a much bigger piece of he would have done much better. Obviously, it would have been his best trade, the best trade of his life. But it kind of just shows that the mechanism it's not something you can just scope out with math. It's actually very much investor dependent. And I think that, some of these liquidations have been a product of too many short-term investors and too few long-term investors. And again, that's what Novora is working on solving by bringing in more long-term investors. And it's partly what you guys are solving by getting the word out there and getting more long-term investors into the ecosystem. So could go on at this point, but I'll
yeah. Dope. That you guys covered a lot there, and that was really insightful. Thank you. I think the first big criticism that I see with MetaDAO overall is the founder flexibility, and you guys addressed that quite well now. But another one that I often see is, and this kind of connects to it, which is decision markets are not proven. Not only are they not proven on like a grander scale, but they're also not really proven on a startup scale, with all the pivots that startups have to make at the beginning. So what do you guys see as the best evidence that they actually make better decisions than what current governance models we have today, whether we look at traditional finance or crypto? And what would you need to see before saying this is better than a board or a shareholder vote or normal corporate governance? Or I think one of you already mentioned that it's already somewhat better. So I think this question can go to Connor.
I'm actually going to pass this one over to Felipe because he's been involved way longer than I have, and I think we'll have just stronger anecdotal evidence. So I want to just refer this to Theia because they've been involved in MetaDAO much longer than Novora has.
Yeah, I'll give my 2 cents and then let Michael chime in as well. So I don't think you can say that they are proven to be better in any way because there is, one experiment going on with decision markets at true scale, and it's MetaDAO, right? And MetaDAO is a young company at a small valuation relative to the opportunity, and all the companies on it are kind of early stage startups. So we're running the experiment now. What I can say is the other structures do not work for internet capital markets. And I have, the token structure where you trust the founder and early backers to kind of build a business and deliver returns has failed completely. And I think that's not an experiment we should try again because the evidence is just so overwhelming that people will enrich themselves at the expense of outside investors, and that they will also actually not even build a business because you don't have an incentive to build a business with the token model. You have an incentive to pump the price and sell. And even some of these token buyback models we're seeing now have been corrupted by the mechanism where it's the company buys back the token while the team sells, and then the business is gone in a year. So everything that touches that model just corrupts and withers and dies. The traditional shareholder primacy corporate model for capital allocation, capital formation works great. The United States is obviously the best example. Having a set of courts and lawyers who know corporate law well, and building case law over many examples over many years and kind of making it better little by little, that works great. But it does not scale to internet capital markets because it by definition only lives within the confines of one country and one legal system. So, there's a path for the SEC to make it easier for, somewhat scaled US companies to raise funds, technically on chain. That's great. But how are you going to cover, the 8 billion people in the world with that model? You can't, right? So I think when you're talking about internet capital markets, which is the dream here and is the big outcome, we know the 2 models that aren't decision markets have failed. And then I have many reasons to believe that decision markets will succeed, but we can't say that for certain now. We're running the experiment. I think we'll see how DPI and revenue created per dollar investor work out for MetaDAO, and we'll have to track the results.
I think it's a good way to put it. Okay.
And on traditional equity, I don't think it's the right comparison because not to say it's a solved problem, but right now, the problem in capital markets is that the private markets are actually too good. The product, if you're a good founder, you can go up to $1 trillion or now 1.75 trillion of value. In the private markets, you have a way of less disclosure. You control your board, you control your shareholders. It's actually too good. And so the question, if you listen to the SEC, CFTC, is do we need the private markets to look like the public markets or public markets to look like the private markets? And the voting so far has been to make the public markets look like the private markets in terms of non-quarterly disclosures and things like that. I'm not as excited, honestly, on ownership dimensions there. I think that there are things that need to happen, like ISS needs to go away, Glass Clark, the other two. There's like two big kind of who all passive funds vote through, how they do their corporate governance, and most capital is now passive. JP Morgan actually banned ISS and their products. You're not allowed to use it to make a shareholder vote anymore. And I think way more interesting is what are the net new constructions that can use this? Because the things that got me excited in life are things like Bitcoin that just don't look like the thing that came before them, and they need underlying primitives that are flexible and much more interesting. And I just think you get more talented people with more aligned values. And when we think about why we care about MetaDAO is, I think the idea that it's got the value system of an L1 is what we care about, and it's attracting a certain type of person who wants to build in a certain dimension. And one of those dimensions is the newness, the novelty of trying to do this stuff. We like people that are thinking of novel ideas, and we would much rather solve novel governance than fix, OpenAI's kind of weird structure and Sam Altman getting fired and all the other traditional board stuff. That stuff is just not that interesting to us.
Yeah, I want to double click on that a little bit. So how do you guys think about what MetaDAO is on an economically? Is it a launch pad? Is it a governance layer, an exchange, all three? Do you think on a long enough time scale, are the trading fees enough to support this $1 billion outcome? Or does MetaDAO need another revenue line, or which needs to scale?
We think it's a services business first and foremost, and it serves two customers, founders and capital. Everything's kind of a service business if you chop it that way. And so whatever the best founders need is what they should provide. If it's quick, fast, cheap, low cost of capital, then they need to do that. And whatever the best investors want, they need to solve for that problem. If you do solve that problem at scale, we have zero concern about its ability to monetize. If the best founders want to come there, you'll find a way to generate a take rate. And so that's not to punt on the question of monetization. It's just to suggest that if you are in the middle of brokering the best founders and the best capital, you're going to be a very valuable place. So, yeah.
I agree with that fully. And then the current model is nice. Like if you're charging 50 bips on assets that turn 10 to 20 times a year, which is pretty standard in this industry, then you're getting like 5 to 10% of kind of valuable AUM on platform. That number can scale, number can scale into the billions. And then the math works really nice. But I think the meta lesson is what MJ said, which is like, if you build this business properly, you'll have plenty of pricing power.
I will note, John was the one who flagged MetaDAO at the firm, and we actually did the deal because the monetization turned on. Like once we saw that monetization was happening, it became an absolute no-brainer. And so that's not to suggest that you don't have to have a real economic engine. That's actually why we got across the line. But that I wouldn't be too specific. I'd solve for the bigger problem of being the best service for founders first.
That makes sense. So I'm curious about the strategy here. Do you think of these investments in these ownership coins, how do you size those? Is it more of a venture style basket? Maybe you expect most to go nowhere and one to carry, or do you try to concentrate? I'm just curious, is there a different risk return profile of something like an ownership coin?
Yeah, it's a good question, and we think it will evolve. Today, we kind of treat them all as traditional equity-like investments of just, we underwrite the business, we size it based on the size of the fund, number of names we want to own. We so far have tried to size them quite equally with the naivete of we can't pick winners. And so it's more of a sizing construction contemplation. I think the biggest question will come around the governance. If we are basically saying if this goes below NAV, we will close it out and return capital, then you're kind of in like a negative rate loan with an equity kicker or like an equity warrant on the other side, and you'd price that as a collective product. I hope that's not how it gets priced, but today that would be a very reasonable, sane model because you have much better downside protection than you would in a venture structure where you go to zero. So your kind of loss rate will change dramatically, and so your sizing math should change. I think the second question is really what type of businesses are attracted. Connor and the group have found a lot of like nice real businesses recently, a lot of payment businesses, a lot of kind of remittance businesses. Those have a specific kind of entry price and TAM that they can possibly be. They're great because you can buy them sub 10 million and you think 30 to 100 million really makes this thing, the math work here. If that changes, then the sizing math should really change of what price you're willing to pay up front and then what's the terminal outcome you would expect. And that's how you do your discount rate for sizing, et cetera. So point is, today we size it kind of like a venture portfolio. We have a bunch of them. They're sized quite equally. In the future, we would change that based on kind of the constitutional and the properties of the underlying businesses themselves.
So we actually do run this quite differently. And I think that there's part of the value we want to create in MetaDAO is to have investor diversity across the board. So we actually can size these. I think the difference in size in a portfolio between the largest and smallest ownership position is about 10x. So we do size them quite differently. And then we also actively add to positions as we gain conviction. So oftentimes we'll start small and then we'll add as we kind of speak to the team, gain conviction in them as founders, gain conviction in the idea, find ourselves doing more with the team, which is important to us as investors. And that I think is actually a really big advantage to us of liquid tokens versus traditional equity, that you can size in and out, when things don't go as well, based on your relative conviction level and new information hitting the market. And it's not obvious if that's the better way to do it, but it's the way that we do things, and we really appreciate it. And I think over managing liquid tokens, we found that those small size in, size outs, more importantly, size ins really for returns can make a huge difference on your ultimate return profile. And I just highlight that because it shows the value of the ownership coin liquid structure versus a traditional equity raise, where you can gain a lot of conviction in the founder over time and not be able to reflect that information in your sizing. But I want to say one thing really fast on what MJ said at the end, the types of companies that are launching on MetaDAO, completely separate topic, but it's really important. The kinds of companies that are launching on MetaDAO now reflect the investor preferences of the people willing to fund these companies. And I had a debate with somebody recently who worked at a large VC fund that was saying, I don't really like the types of companies that are launching MetaDAO. They don't seem to me like 1000x outcome fund returners. And I said that's true. Like some of them, I guess you could argue whether they can be or can't be, but I get what you're saying. Like on average, these are not the kind of swing for a home run, miss the zero, and then win it's 1000x outcome opportunities that you see venture funds, certain types of venture funds prefer. And the reason why is because, the liquid funds that are there are kind of happy with these small good businesses that can grow into a pretty reasonable 10x, and then maybe they can grow much bigger, but you kind of have the reasonable, visible path to the 10x in the financials. We like that. So those companies are going to MetaDAO because they can get funded. The reason I say this is because we need more diversity of investors to pull in other types of investments. It's not that MetaDAO as a mechanism shouldn't bring in the 1000x, hit or miss world-changing project. It's that the people who invest in those projects are not really in the ecosystem yet, except for DBA. But you guys are a little outnumbered by liquid funds right now.
And what do you guys make of, and I know, nobody likes to talk about price action in the bear market, but I think it's definitely interesting to at least notice that a lot of the ownership coins are down from all-time highs. And what do you guys make of that? Is that the market mispricing it? Was it like people got too hyped up about it? And what do you guys make of all the? I think Meta is like down 70% from the all-time highs. Is this the evidence that the structure isn't working yet, or that it's not perfect, or is it just correlation with the broader market and sentiment? And Theia, Michael, either of you can answer this.
More sellers than buyers. It's just, I think it's correlated. Look, the test will be DPI for people who invest in ownership coins and per dollar invested over, as a kind of time series. That's our test of whether the mechanism works. Price will move up and down in this industry. Every asset is vol 200 in certain years, and there's just no escaping that. And I mean, the mechanism is obvious. Like, funds are going out of business, they're pulling capital, they're selling all their positions. Literally last week, I know a fund that went under, sold all their Meta because he sold every position. That you can't escape that correlation. So, we're looking at the actual KPIs underneath.
Yeah, my background was at Galaxy when it started in 2017, and Novogratz ran the liquid side. We had a huge liquid book, a couple $100 billion a day of risk, and I was on the private side. And we had a collective investment group every once in a while. And what you learn very quickly is your brain actually can't really think in 2 time windows at the same time. It's basically impossible. If you're checking CoinGecko more than once a week, you are probably not a long-term investor, to be honest. Your brain and emotions will just get confused by it. And we tried it. We tried everything at Galaxy to really construct the correct ability to express across many different dimensions of risk, time, and returns. And my view is, one, these markets are so illiquid. Our position sizes are meaningfully higher than any of the liquidity we could actually take and want to express in these markets. And I know Connor and groups are working on providing liquidity. So the market impact of any single individual is just it's so outlandish compared to a traditional market that we just don't think that there's a ton of signal in it. I think it is a very important thing for the asset, its price signal of attracting people. That's why people invest in many of these things or all of these things. But I think it's very important that whenever you ask a question, you have to be able to answer on 2 different time dimensions, now and later. And firms, very, very few firms are able to do both. It's an extremely rare trait. And honestly, I'm not even sure it ever makes sense to do both. So
I did want to ask you a specific question, Michael. Well, we still have you. Projects can mint and sell these fresh tokens through decision market votes. So like a strategic supply increase. Obviously, DBA knows this very well. Do you think like governed market price dilutions are actually a feature or like a clean way to raise without dumping on holders? Or do you think it's still dilution you have to underwrite like any other? And you have to trust that decision market gates keep it honest?
I think it goes down to team trust. I think that the reason that Pump trades at such a bad premium and Hype trades at such a good premium is just team trust. We make all of our money on multiples at the end of the day. It's the fundamentals get you so far, but multiple expansion is how you get money. And the way you do that is from having a good, clean founder who communicates honestly, directly with a set of values that are legible to the shareholders and consistently with that set of values. And every time you break that set of values, I think you erode trust and you cut that multiple down. And so if Elon does it and he's like, hey, I'm going to go build a rocket, everyone's like, yeah, that's amazing. If someone who people are cynical of do it, I think that they will be penalized. So super conditional on trust in the founders.
Yep. And Connor, and hopefully you can answer this one. You know, what I've noticed is all the MetaDAO tokens have been doing these token transparency filings, and I think that's a very good move ahead in our industry. And I really love that it's coming from Blockworks, and they have to make all these disclosures. In your opinion, what's like the single what's like the single number or disclosure you wish every one of these companies published that maybe none of them do, or something you would like to see more of?
Yeah, I think just like founder integrity and transparency and communication is just like super important. And like MJ alluded to a little bit ago, like teams are able to underwrite management and leadership that is communicative, high integrity, open, transparent. And like you see the way, and specifically like the way things are priced based on management and leadership within this certain company or protocol. And the asset class is maturing, and people want to see that. And maybe like fundamentals of a business aren't like super great, but maybe they're improving. But like the management of the team is great, and maybe you're willing to like underwrite that risk. Because like, all right, I trust the founder. He's super transparent. We like his leadership style. I just think the industry needs to mature, and like that was one of our core theses for starting Novora is like, okay, if this asset class actually wants to mature and further institutionalize, like you need to see certain initiatives that traditional equity markets and traditional markets implement. And a lot of that is transparency. And I really allude the Blocmates guys for rolling out the TTF last year. I think it's a great first step for the industry, and we just need more initiatives like that. And like that's one of our goals this year is just to like help founders and teams become more transparent, be more communicative, speak with investors, speak with the public markets. I just think it's a byproduct of the asset class maturing. So we're doing everything in our power to help the teams that we work with and the teams that we don't work with just really become more high integral and communicative there, and just open. Whether it's good news or bad news, like the market will appreciate, I think, transparency.
Completely agree. Yeah, transparency is the way to the future. We're running close on time, but I just want to go around the room real quick. I want you guys to finish the sentence. I would 10x my allocation to the category the day I see blank. What are you guys thinking?
Something I use daily.
I like that a lot.
I will 10x my allocation to the category when there is 10x more supply, so that I can easily do it.
Pragmatist.
I would 10x my conviction if we get net new participants and personas involved in the ecosystem. Obviously, there's a very niche cohort right now, and it's our goal to go expand that. So I think that'll just help push this ecosystem much further down the road as well.
Yeah, and the last thing I'll say that I want to leave on is we are blessed to have some institutional investors at DBA, and we have to tell stories about what's happening in the asset class. And I always have to find something that resonates with a really broad group of people. They could be fixed income in the meeting before, and then I have to explain to them futarchy. This lands, people do actually just conceptually understand why this makes sense. There's high variance on whether it does, but there is lots of really good long-term capital that they care about this stuff, and they get it because they get why it's pernicious and destructive and a problem across the capital formation stack. So there is a lot of education, but there's a lot to work with here. And I think it's a really positive story that works at the next scale of capital.
And I'll just do one more finishing point to kind of follow on Connor's point. If you are a fund or a large allocator and you want to see a certain type of company launch on MetaDAO, reach out to Novora, reach out to the MetaDAO team. Like, this is fundamentally an ecosystem that responds to investors. Like, investors are kind of the upstream pool here that shapes how everything looks downstream. And if you don't like what you're seeing in terms of launches, or they're not that interesting to you, that's because you're not engaged with the team, you're not engaged with Connor, you're not helping recruit the next launches. The market will morph to the capital that's willing to allocate here. And I'm happy that all the companies that launch are interesting to me, but I'll be much happier when only 10% of them are, and the other 90% are for different investors.
And one last round of a rapid fire question. This is going to be the last question for you guys. You can just answer in like 1 minute. It's going to be a very simple question. What do you guys think is the most underrated mechanism in MetaDAO? Is it the legal part of it? Is it the decision market? or something else? We can start with MJ.
Just simplicity, standardized terms. That's what matters to us. We can do it much faster. We look at the page, John and I have a call and we make a decision. That's so much easier than a 75-page pref doc.
Yeah. Felipe, you can go next.
I'm sorry, I'm going to say two things, so apologies. One is I think that people don't really understand the market cap and downside protection. So, when you invest in a company that raises $4 million, the circulating market cap is $4 million. And what the team has is warrants. And that is the right way to do liquid venture, because teams that haven't created, if teams that are building companies deserve to make money when the company does well, right? Everyone kind of gets it intuitively. With tokens, teams had a big part of the supply of the token immediately, right? And they just had to wait to vest it. It's a very different mathematical structure than what you do with MetaDAO, where you have a $4 million valuation and the team only gets their piece of their piece. You only get diluted if the investment does well for you as the ICO investor. So I think people really don't appreciate how much downside protection you have with the ICOs. Because I know that because we speak to people and they kind of say like, oh, this is raising at a $15 million market cap. And we're like, no, it's not. It's raising at 4 or 3. And 15 million is what happens when everyone makes money. But by that point, you're up 32 times on your money. So I think just people need to grok that for the investment class. That's the long answer. The short answer is I think the most underrated mechanism is team options. Kind of piggybacking off this. We are seeing teams on MetaDAO subjectively ship faster and focus more on creating value than other token teams on average, not in every case, on average, because their incentive is to make token price go up. Otherwise, they don't get their warrants. Whereas other teams, their incentive is kind of just to wait and hope the market comes back. And we're seeing those incentives reflected in team urgency, in team effort, and in the shipping of the underlying product.
Yeah, Connor, you can go ahead and tell us the most underrated in your opinion.
Yeah, I've got two to kind of coattail off Felipe. One, I think, is just like the concentrated alignment. Like you don't have the historical misalignment that you have with like the equity business and token holder business. So the actual nature of the claim on the IP and the company itself. So I think that's one. And I think secondly aligns with price discovery starts at a much more attractive valuation relative to historical token launches. And with that, all of the growth can occur in the public markets. So if you have a company that launches at 4 million and they execute and the team's incentives unlock at certain milestones, that growth is occurring in the public markets, which is great, which is what you want to see relative to historical token launches where prices get marked up in the private markets and then the token launches at $1 billion. There's price discovery starts at $1 billion. There's no natural buyers because it's overvalued. The valuation is not earned. And then the token's down only from there. So I think one, just like natural alignment. And then secondly is the growth occurs in the public markets if the team executes.
And I believe that is it. Thank you guys for joining today. It was a pleasure to have you on. It was a really great conversation. I wish it could have been longer, but maybe next time. Also, shout out to Blockmates and 563 here for co-hosting this episode. And on my end, that's it. Thank you everybody for joining.
Yeah, thanks everybody. Super happy to help co-host this with the ownership guys. Thanks again to the speakers. This was awesome. I think this is probably the best ownership coin chat we've had. And see you next time. Thank you.